As we've emphasized over these lessons, risk management is a significant factor to your success as a trader. In this lesson, we'll show you a tool used to protect you from big losses, the stop market order. Essentially, a stop market order is a conditional order. It asks the simple question, did the price hit the specified number? If it did not, don't do anything. If it did, close the trade out. And it's just that simple. A stop market order is triggered at a specific price. Once it's triggered, a market order is placed to exit the position. As you map out your trades and set your entry target and stop loss, you will use a market order as a stop loss to exit a trade to protect yourself from large losses. The good thing about a stop market order as a risk management tool is that it gets you out of a bad trade no matter what. The not so good thing about a stop market order is, once again, slippage. Let's look at a couple of examples. Here's our trade setup. We identify the demand zone and wait for price to drop into the zone. Once it does, we want to protect our position. In this example, we enter long at $34.30 and want to make sure that we get out at $34.15. Every trade is different, but in this setup, we're willing to risk 15 cents per share. So how do we protect ourselves? We go down to the order bar and select Stop Market under Order Type. The platform will then ask you at what price you want to trigger the stop loss. If the price hits that number, an order goes to the market to get us out of the trade. Think of it as an if-then type of event. If the price hits $34.15, then a market order is sent. Since we're going long, we hit the sell button to set our stop market order. Now we've protected this trade from significant loss. We estimate a 15-cent stop loss based on the stop market order. If price falls quickly, we may not get filled at $34.15. It may get filled at $34.14, $34.12, or even $34.10, depending on how fast the price is moving. But at least we are out of the trade with only a small loss. We use a stop market order for short positions as well. In this example, we identify the supply zone, and as price enters the zone, we open a short position at $34.30. After analysis, we place the stop loss at $34.45. This means that if price continues to move up, we'll take a small loss, 15 cents per share, instead of a larger loss. To place the order, we go down to the order bar and select Stop Market Order under the order type. We enter the price at which an order will be sent to exit the trade. In this case, it's $34.45. Since we're going short per this example, we hit Buy to cover, telling the program to buy to close out our short position. Once the order is sent to the market, we're now protected from taking a significant loss. There is a chance of slippage, and if it's a fast-moving security or has a gap, we could lose more than 15 cents per share. The important thing is that there is a mechanism in place to prevent us from taking a significant or large loss. Remember, a stop market order is a risk management tool used to prevent large losses. It's used primarily as a stop loss and sends out a market order to exit a position once a specific price is triggered. It's good for getting you out of a trade, but it's also susceptible to slippage. Now you know what a stop market order is and how it's used as a risk management tool to protect you from large losses. Before you move on, ask yourself what and how are stop market orders used for entering and exiting a position. Ask yourself what are the positives of using a stop market order and what are the negatives of using a stop market order. Hope to see you in the next video.